November came to an end with an impressive rally in bonds and a significant meltdown of the bond yields that offered near record gains to the S&P 500 stocks. Now, obviously, the most heated debate at the start of this December is whether the exceptional November gains will spoil an eventual Santa rally or not. So welcome. This is Swissquote's Daily Market Talk. So here we are saying thanks and goodbye to the excellent month of November for both bond and equity traders. US bonds rallied and the US bond yield melted starting from the end of last October, remember? And the melting that we saw in the US bond yields actually offered to the S&P 500 stocks one of the biggest gains for a month of November. The index actually rallied more than 9% through November, is up by more than 10% since the end of October dip, and parallelly, Nasdaq 100 gained nearly 12% last month and is up by 15% since its October dip. Now, note that yields are one and obviously an important part of the valuation story, because when the return for low risk assets decline, like the US bonds, for example, well, the valuations of riskier assets automatically move up. So that's mathematical, and that's one leg of the equation. But there's also this fundamental leg to the US equity story, and it's also, well, quite positive, really, because hot off the press from the US Bureau of Economic Analysis, well, latest data pointed at a 3.3% growth in total corporate profits during the third quarter of this year, reaching an annualized rate of almost 3.3 trillion US dollars. So this figure falls just short of the previous all-time high peak of 3.3 trillion US dollars recorded in the third quarter of 2022. And the significance lies in the fact that this profit increase actually demonstrates the adaptability of US companies to the post-COVID operating landscape, meaning to elevated wages and to increase borrowing costs. So the debate right now is obviously, as you guess, will such a strong month of November spoil our Santa rally, or the US stocks will actually just continue to extend their gains through the month of December to the end of this year? Now, looking at the aggregate company fundamentals, well, there is no apparent reason for the US stock rally to stop suddenly, unless shocker data pops up, like very bad jobs data, for example, or a very sharp decline in US growth numbers to below average level, so that would be below 2% level. And even then, a part of that bad data would be kind of tamed by soft Federal Reserve expectations, right? And my last 10-year experience in the financial and the stock markets actually reminds me every day that valuations, equity valuations, are never too high. Of course, the past decade, while the market was constantly navigating in this zero interest rate regime, and that's obviously changed since last year, but it still feels like you are never thin enough, you are never rich enough, and equities are never, well, valued enough. But on the other hand, looking at the technical indicators, well, the US equity markets are now in the overbought market territory. This means that they have been purchased too fast and in a too short period of time, and that a minor correction, at least a minor correction, would be healthy in the next few sessions of trading. But the latter doesn't rule out a further rally when the overheated technical indicators actually cool down. And in this respect, an analyst at Strategas, this is I think how you pronounce it, well, told Bloomberg News that there is a clear bias that a very weak November performance has been followed by a strong December performance, but that the opposite is not true, and that December performance in the equity markets tends to be even, following strong gains in a month of November. So we will see what happens this December, but we know that bond traders are also expected to take a breather soon, like quite soon at the actual levels, and the bond rally is also expected to consolidate near the actual levels after last month's impressive rally, because note that the US 2-year yield became sort of vulnerable to strong economic data from the US and some hawkish Federal Reserve comments following a 65 basis point fall since mid-October, and bond investors are also probably searching for a dip near the 4.25% level in the US 10-year yield. So a potential rebound in the US yields could also help the US equities consolidate and perhaps correct to the downside. Yet, note that many bond traders out there prefer looking at the bigger and the larger picture than just what happens over the past month and so. And they say that, well, you know what, the bonds rallied big since a month and so. Yes, that's true, but they are still around 50% cheaper than the last decade. And that's also true. And although we all agree that last decade, which was a decade of no consumer inflation and zero interest rates, and which will be very, very hard to replicate in the future, and the markets will have to swallow the exploding debt levels in the US and elsewhere without the help of the Fed and the central banks, well, at least until inflation falls back to the sufficiently low levels, well, it's going to be hard to see the bonds rally to the levels that we saw over the past decade, but they're still 50% cheaper. Now, the good news is inflation falls, because yesterday's PCA data confirmed that the US PCE index fell from 3.4% to 3% in October, and core inflation eased from 3.7% to 3.5% as expected. The fact that the data came in line with the market expectations gained little traction among bond buyers. Of course, as such, we saw the US 2-year yield rebound past its 200-day moving average right after the data and consolidate there this morning. Yet, note that inflation in Europe came in softer than expected by analysts. In fact, inflation in Eurozone fell to 2.4% level in November from 2.9% printed a month earlier. So it was also much better than a fall to 2.7% expected by analysts. And core inflation also is more than expected to 3.6% level. So the euro dollar fell below the 109 level, and losses could actually extend toward the 108-108.20 region, including the 200-day moving average and the major 38.2% Fibonacci retracement level on the October to November rebound. Now, we know that inflation can be a bit tricky and tends to make unexpected comebacks, and Europe isn't completely out of the woods just yet, as the European jobs market remains quite robust and wages growth remains satisfactory. However, one of the major drivers of inflation in Europe, which is the Russian gas nightmare, is gently over by now, as the region has taken massive and meaningful steps to prepare itself for this winter. And it was to just reduce its dependence on the Russian gas. So in this respect, only 12% of gas that Europe imported came from Russia recently. So that's a big drop from the 40% before the Ukrainian war started. Moreover, well, OPEC actually seemed kind of overwhelmed with events this week, as the group, the cartel, announced an additional 1 million barrel per day cut that will be shouldered by the cartel members and not only by Saudi Arabia, on top of the 1 million barrel per day cut that Saudi Arabia will be extending to next year. Then they will be, cutting along. The latter was nowhere near appetizing to get the oil bulls running, however. The barrel of US crude fell to $75 per barrel level and should continue finding sellers into its 200-day moving average that stands near the $78 per barrel level. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and interesting feedbacks. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. And please do not forget to hit the like button on these videos to let us know that you actually enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.